There's a lot of bears circling the street. We've got stock markets now in bear market territory. You've got gold ticking a little bit higher. How risk adverse are you in this environment?
Well, first of all, sentiment is very, very risk averse. I mean, we started the year on the very soft foot and largely driven by the very high fixings in the dollar China that has spooked markets a lot. Listen, I think the bottom line is sentiment right now. From a fundamental perspective, I share a lot of the views. I'm not a buyer of the hard landing in China. But nonetheless, the issue of sentiment is a very crucial one because things can quickly escalate out of control.
Strangely, though, where you've seen a further sell-off on markets that's taken us lower throughout the course of 2016, even though it's early days, you haven't seen another dramatic shift higher in the dollar on safe haven flows. Why is there no correlation in that trade these days?
I think there are two reasons. First of all, from a broader perspective, the dollar trade is now tired. I think the dollar has moved way above rate differentials, what they would suggest. And secondly, if you look at the euro, there's been a negative correlation between the euro dollar and risk on, risk off trades, which means that the euro goes higher when you get sell-offs in risk.
But are you surprised to see the euro in making these moves, given that there's still quite a bit of expectation we could see additional easing coming from President Draghi?
Not really, no. Well, our view has been, we have been constructive on the euro for the past 3-4 months or so, largely because of a very large dollar overvaluation. But at the same time, I think we need to gain some perspective here, right? We get 0.1, 0.2 misses in the CPI, and then everyone gets excited that the ECB is going to throw another trillion in the market. I mean, at the end of the day, these things could have unintended consequences. And so I think for now, Draghi is going to maintain a dovish stance, but I don't think we're that close as some people may actually think on QE3.
So even when you look at the dramatic declines in oil prices now below $30 a barrel, what that means for the inflationary pressures to the downside, doesn't it suggest that the central banks have to do more, specifically from the ECB?
From a fundamental perspective, I would say no. And that's largely because I see the fall in oil price as emanating largely from the supply side of the economy. And in principle, it's not really the central bank's job to fight that, to push back on that. And at the same time, let's not forget that it is really having a beneficial effect into real incomes and consumption, oil at so low prices.